Welcome to The Explainer. Today, we're diving deep into Ericsson's Q3 2025 earnings report to uncover what I think is a truly fascinating corporate strategy mystery. You know, if you follow the telecom sector, you already know it's been a pretty turbulent year globally. But Ericsson? Well, they've somehow managed to pull off a financial magic trick that absolutely demands our attention. We're going to break down exactly how they did it using the numbers straight from their latest earnings call.
Let's start right out of the gate with a rapid-fire metric, a 2% drop in organic sales year over year. Now, in the telecom equipment world, a contraction in top-line revenue usually spells trouble, right? It signals market hesitation, maybe delayed rollouts, or shrinking budgets from the major carriers.
But here's where we hit the contrast. Despite that 2% sales drop, Ericsson's adjusted EBITDA margin actually jumped to a three-year high of 14.7%. That is a massive achievement in this kind of economic climate. They are literally squeezing more profit out of a shrinking revenue pool.
Okay, let's dive into this. This is the central paradox we're solving today. How on earth does a tech giant with over 56 billion Swedish krona in quarterly sales manage to just defy financial gravity? Well, it's basically a masterclass in restructuring, operational discipline, and future-proofing. Here's our roadmap for today. We'll cover 1. The profitability paradox, 2. Driving operational excellence, 3. Segment breakdown, and 4. The 5G and AI future.
Section 1. The profitability paradox.
To really understand Ericsson's success this quarter, we've got to look past that top-line revenue and focus entirely on the margins. Over the past year, the rolling four-quarter adjusted gross margin has climbed steadily, kind of like a staircase, moving from 41% to a highly sustainable 50%. This is the hallmark of a company that's steadily getting more efficient at delivering its core products, absolutely regardless of the macroeconomic weather.
Now to truly grasp these numbers, let's quickly translate some financial jargon into plain English. You're going to see adjusted EBITDA pop up throughout their report. Simply put, this is just a measure of operational profitability. It strips out all the noise, taxes, interest, one-time restructuring costs, so we can see exactly how profitable the core, day-to-day business actually is. And at 14.7%, Ericsson is operating at a seriously efficient level.
Another vital health metric to look at is free cash flow before mergers and acquisitions. Think of this as the actual, tangible cash generated by normal business operations that goes straight to the bank. This quarter, Ericsson hit a massive 6.6 billion Swedish krona. That is a ton of cash under the mattress, which ultimately gives them so much more scope for increased shareholder returns.
Section 2. Driving operational excellence.
So how is CEO Börje Ekholm actually pulling this off? Well, it really comes down to deliberate, strategic choices. They've implemented some rigorous cost reductions and totally optimized how they deliver both software and hardware. But hey, we can't ignore the masterstroke of the quarter. They secured a massive 7.6 billion krona capital gain simply by divesting their iConnective business, an incredibly savvy move that heavily padded their cash position against market volatility. It's actually fascinating to look at this through the lens of an offshore wind farm. They aren't trying to fight the headwinds of lower operator spending. Instead, they're building a resilient, leaner machine capable of harnessing those exact macroeconomic winds to generate cash, even when the conditions aren't perfectly in their favor.
Section 3. Segment breakdown and performance.
First up, the geographic contrast is pretty stark. The Americas saw an 8% decline in organic growth. But, context is everything here. This is largely because Q3 of 2024 had exceptionally high delivery volumes, which just naturally makes for a really tough year-over-year comparison. Meanwhile, Northeast Asia is surging with a 10% organic growth rate. It shows that while the U.S. market might be cooling its initial 5G rollout a bit, other global regions are aggressively stepping on the gas.
When we compare the product segments, that profitability paradox we talked about comes into full focus. Both networks and enterprise experienced organic sales declines of 5% and 7% respectively. Yet, somehow, both managed to maintain incredible adjusted gross margins of over 50%. They're aggressively defending their bottom line, even as sales volumes shrink.
Diving a bit deeper into the network segment, which, by the way, is Ericsson's bread and butter at 63% of total net sales, we see something truly remarkable. Despite that 5% sales dip, they've stabilized the rolling gross margin at a new high of right around 50%. This absolutely proves their cost-cutting measures aren't just temporary band-aids. They've structurally elevated the profitability floor.
And we definitely have to give a quick, energetic shout out to the Cloud Software and Services segment. This division was the absolute growth star this quarter, boasting a 9% organic growth rate. Not only did their sales grow, but their gross margins hit a new high level too, driven directly by improved delivery performance. Basically, they're selling more and they're delivering it way more efficiently.
Section 4. The 5G and AI future.
Now, you can't just cut your way to long-term growth forever. Eventually, you have to innovate. And a massive part of Ericsson's future hinges on FWA, or Fixed Wireless Access. If you're not familiar, this is the tech that delivers high-speed broadband to your home using cellular radio networks, like 5G, instead of digging up the street to lay traditional fiber optic cables. It is literally a game-changer for deployment speed. And check out this surprising fact straight from the Ericsson Mobility Report. Fixed wireless access is projected to account for over 35% of all new broadband connections globally by 2030. That's a massive structural shift in how the world connects to the internet, and Ericsson is positioning itself perfectly to supply the infrastructure for that coming boom.
This high-level strategic vision of weathering the storm is directly powered by on-the-ground reality. We're talking rigorous R&D, with engineers working hands-on with advanced radio hardware, which fuels their future-proofed 5G Open RAN-ready portfolio. They are fighting tooth and nail to maintain tech leadership, so that when operators are finally ready to spend again, Ericsson has the absolute best gear on the market.
If we zoom out to the macro technological trends, the data strongly supports Ericsson's long game. 5G is forecast to hit an astounding 6.3 billion subscriptions by 2030. Over in Europe, 5G mid-band coverage just reached 50%, which means there is still massive room for build-out. And crucially, the explosive rise of AI applications is fast becoming a key driver for new, robust network investments. The data pipes simply have to get bigger, and Ericsson is just waiting to build them.
Which brings us to this defining quote from CEO Börje Ekholm, basically summarizing the core theme of our explainer today. By structurally improving the business through rigorous cost management right now, Ericsson is well positioned for long-term success. They are doing more with less today to guarantee their stability and dominance tomorrow.
So, what should you actually take away from all this? Well, Ericsson has definitely proven they can squeeze record margins out of a shrinking market. But here's the provocative thought I want to leave you with. As the impending wave of AI applications forces a massive, inevitable boom in global telecom infrastructure, is Ericsson's newly lean, highly profitable machine perfectly primed to capture that surge, or have they cut a little too close to the bone? Based on their Q3 margins, my money is for sure on a highly profitable future. Thank you for joining me on this explainer, and keep learning.